Hi, I'm here today with Jim Better, and Jim is an insurance broker. And Jim, why don't you give everybody an introduction to who you are and what you do?
Okay. Um, Thank you. Thank you for the introduction. I run a company here called Essential Plans of Insurance. And for the last 15 years, my agency is focusing on helping people recognize that there's a risk of needing to have help when they reach the vintage years. The specific diagnosis is needing long-term care, which breaks down into simple components, needing help or assistance or supervision for bathing, dressing, meal preparation, and so on. I started this business when my mom got sick 18 years ago. She had cancer. She survived 3.5 years, and she burned through $300,000 in her care. She was very disappointed because that money was earmarked for my brother and sister and I, but she used it all up on her care. It got me thinking that there must be a way for insurance to be able to cover this, and went out and took a long-term care insurance policy for myself because I didn't want my assets to be distributed, go just for long-term care. I wanted to go for what my wishes are, that is distributed, take care of my wife, and then subsequently distributed to my children. I think I don't want to be a burden to anybody when that day comes, because 70% of us at some point are going to need help with those things. And I want to be able to make my own conclusions about what I want that care to be, where it's going to be, and not use up all my own money and let an insurance company pay for that care.
Right. Now, I was reading some of the information you shared with me earlier that on average, people need about 3 or 4 years of long-term care when they tap into it. And they need it for conditions like my mom, as we discussed previously, my mom had Alzheimer's. It was long-term care needed, but um, we had a lot of support. She had a partner. My dad passed away, and my stepdad passed away, and she
Mm.
never had any problem, attracting partners. And so she had a very good man who stepped in and helped out with a lot of this stuff. And it wasn't until the last 2 months of her life that she needed to go into a long-term care facility. But talk to everybody a little bit about what they can expect, what it covers, and the costs involved in terms of what kind of a hit uh, a family can expect if they don't have this kind of coverage to take care of mom or dad if they get a chronic debilitating disease like Alzheimer's or Parkinson's or some of the other diseases that can really linger for a long time.
Yeah, it's a good question, Will. I mean, there are statistics, and statistically, from a government standpoint, they say that women generally will need care for 3.4 years, and men will need care for 2.8 years. I guess we can draw a conclusion that women live better in captivity. I'm not sure how that plays out, but nevertheless, those are the statistics. And people apply for when they need long-term care. Generally it becomes as a matter of needing help with two activities of daily living. Now, it's many people, most people, in fact, these days, when they need care, they want to have it at home. They don't want to go to a facility, assisted living, or a nursing home, or even residential care because of the COVID thing. But even without the pandemic, people's wishes still are that they want to be able to stay at home for as long as they can. In
Like
familiar,
my mom
yeah.
was able to stay at home until she was 85,
Mhm.
86.
Yeah,
So, and that's what I know that she loved her house and she wanted to stay there as long as she could.
yeah. And from a normal progression, the way it works is people need help a couple hours a day, or maybe 4 hours a day. So you have a home care agency come in and they help with that. Then it progresses. Then maybe becomes 6 hours. Then maybe becomes 8 hours. And when things get to the point where it's 24 hours of care, then it's time for facility care. But it doesn't start out going from day one being healthy to day two needing to have help with those types of things. It's a progression thing. And most insurance companies, all the insurance plans that I know of, start out with or have included in them home health care. And generally that gets paid for at 100%. When you move into a facility care, then maybe there's less coverage, but nevertheless, how the policies generally work is you're buying money. You're saying, okay, if I'm a male, I'm going to live 2.8 years, and if the average cost per year is $100,000, then I need about $280,000 worth of coverage. And that's what insurance policies do. You put a little money in to buy a lot of money to come out. And in the last 10 years or so, insurance companies have come up with those two models of insurance plans. There's the traditional style plan, which is much like home and auto, home insurance, car insurance. You pay for it. If you don't use it, they don't send you any money back. And the traditional style policies are the same way. However, they're different in that when you need care, now the premiums stop, and now the care and the money comes out to pay for care. The hybrid policies are different in that they're really life insurance policies with a long-term care rider. With these contracts, as the insurance world describes it, they're contracts live, die, or quit, they pay off. If you live and you need long-term care, it will pay for those expenses. If you die and never need the care, it pays out like a long-term care insurance policy or like a life insurance policy. And if you, for whatever reason down the road, you say, I don't really want this thing anymore, they'll give you some or all your money back. They're very popular with people who have assets to protect, because it's a matter of just changing where the rainy day fund is being held. You put it into a bank or an annuity, okay, it grows, and that's what it provides is a resource for cash. You put it into a long-term care policy, while it's sitting there, it will provide the long-term care as well as the life insurance.
So let me dive down into this a little bit. So if I buy one of these policies and I never need it, it converts to a life insurance policy and it pays out to my survivors at that point. Right. If I need it, then if I don't have a life insurance policy, I'm out of luck. But what if I only need it for 6 months and there's still, $200,000 of that care? Does that kind of convert to a life insurance policy then and get paid out that way?
It does. Let's take the example of a $300,000 long-term care policy. And if you need care for 6 months and you draw down $50,000 of that and then croak, then there's going to be $250,000 that gets paid out to the survivors.
Got it. Okay.
They're pretty cool plans. As I say, people with assets and have rainy day funds, and repositioning those assets makes a world of sense to the extent that people can get it. One of the issues that people have is that they wait until they get older and then they have a diagnosis of something and they say, okay, now I'll get my long-term care policy. Forget about it. Insurance companies, especially these days, are very aware of what their risks are of having a claim on a given policy. So applying for a long-term care policy when you're younger and healthy makes sense, because when you're older and maybe not so healthy, you may not have that option.
So when do most people, or when would you recommend most people start to do the investigation into, whether they should begin the process of buying it, and does it get more? I'm assuming like life insurance, it gets more expensive as you age, right. And I'm also assuming I have a life insurance policy on me. I had to take a physical, for several weeks before the physical. I was, trying to lose weight and trying to, get myself as healthy as I could to get a better rate. And I'm wondering if that's kind of similar with the long-term care policies.
Yeah, it functions essentially the same way. Mm-hmm. With long-term care policies, whether it's a traditional or a hybrid, there's no physical exam as such. The insurance company will call you and they will ask you questions. They'll test your cognitive capabilities. They'll get your medical history. They'll get your records from your physician, and then they'll make a decision on whether it's a good risk for them to take. If it is, they'll give you an offer for a policy, and then you make the decision whether to go forward with it.
Are some of the questions related to family history? You know, are they going to look at me and say, well, you know, your mom had Alzheimer's and your dad had, you know, my dad passed away, you know, a long, long time ago when I was still a boy. I had a heart attack. And I know I always get that question, whether it's an insurance broker or my doctor, you know, you fill out your forms and, you know, tell us your family history. Is that something that goes into the evaluation of coverage?
Insurance companies are paying a whole lot more attention to our DNA than they ever did before. And yes, with the medical history of your parents, especially if it's a cognitive impairment issue, they look a lot more closely at the application.
Mm-hmm. Well, I was just speaking to a client yesterday and just catching up with him. And I think he just turned 70, or he's in late 60s, maybe 68. And he didn't marry until late in life. He got married, found the love of his life when he was in his late 50s. She was around the same age as him. They got married. They had all their plans. They were going to sell their house here and move down to a nice place down in Orange County. And they did that. And, you know, he's still working full time and she was working full time as well. And a year later, she came down with early onset Alzheimer's. And now it's 5 years later, and she's in a group facility. I think there's 6 other people in this like a home, I guess.
The residential
A
care.
residential care facility, I think. And he said, you know, she's getting, you know, personal attention. But she's essentially incapacitated. She can't feed herself. She can't bathe herself. She can't communicate. And, you know, he loves her, so he's caring for her as best he can. But his life is kind of now just dedicated to, you know, making money to take care of her care. And I'm worried about him because I don't know if he's setting enough money aside for himself to take care of himself. He earns a good salary, he earns a good living, but you know, as you said, $100,000 average cost, that is, you know, that's a lot. Now, how do people afford that if they don't have this? What ends up happening to people if they, you know, don't talk to somebody like you and they don't have an option and they don't have a, you know, like my client, they don't have a, you know, a healthy income that can support their loved one? What happens to those people?
Well, you know, the state of California has a very good safety net. In most states, they call it Medicaid, but in California, it's Medi-Cal. And Medi-Cal is available for people who don't have any money, and they provide the long-term care services that you would otherwise get on your own. I mean, that's the good news. The bad news is the government is going to pay for it. They're going to tell you where you're going to get care.
Mm.
You might end up in Hemet for physical therapy. You just don't know where the care is going to come from.
Oh, really? You don't have an option of which facility you go to or which doctors you see?
You may have a choice of 2 or 3 places for a given procedure, but it's going to be the government determine. Okay, we have a long-term care bed in San Diego or in Chino, or you'll have to go there. One of my friends is on a Medi-Cal plan, and he had to go to physical therapy, but he had to go to Chino for it from Long Beach.
Wow.
Because that's where they had the contract with the provider who would accept the Medi-Cal benefit. And not all doctors and care facilities will accept it because it's a discounted payment.
Sure.
And you know, and doctors and physicians, you know, they're in it for healing people, but they're also in it to make a living, and they would rather not discount their services if they don't have to.
Yeah.
So that's a dilemma that people get into if that's what what they're looking for. As far as your father was concerned, that's a tragic story. A very unhappy story for him.
Yeah. So when back to that question then, when do you recommend that people begin the process of doing their investigation and reaching out to somebody like you?
45 is not too early. I'm seeing a lot more interest from people who are in their late 40s and early 50s, which I'm really, really glad to see that from a couple of standpoints. One is their health status may qualify for them to get a good contract. And then the other issue with calling early and getting started early, in addition to the health history part, is that like these hybrid policies, you can say, okay, I want to pay for 10 years. I want to pay the premiums for 10 years. I want it to coincide with my retirement, and I want to pay for it 10 years. And you can do that. So that once you hit retirement age and it becomes important to control expenses, that's one expense you no longer have, but you still have the coverage.
So wait, run that through me again. So you would say if you're 50 years old and you think you're going to retire at 60, you're going to pay from the time you're 50 to 60, and then your coverage will go from 60 to 70?
Or until you need it.
Until you need it.
Yeah, it's considered a paid up contract at that point, and you're just putting a safety deposit box and let your lawyer know that you have it, and let your family know that you have it.
So that gets to the question of, how expensive is this? Or, obviously it's a lot more expensive to not have it, but what can people, who have never had exposure to this kind of insurance, what kind of rates? I know it's going to be different depending on age and location and health conditions, but in general, what are you seeing? Is it, thousands of dollars a month, or, what are we looking at?
Well, the insurance answer to that question is it depends.
You sound like a lawyer, which I used to be. It always depends. Fact specific, as my professor used to say. Fact specific.
When I work with clients, I always design it around, okay, what can you afford now, and what do you anticipate your future income is going to be? And let's look at what your forecast is when you're age 75. What is your income going to be at that point? And then we design a plan around that. Now, the fact is, yes, if you want to get a contract that will pay 100% of the cost of care, and you want to have it paid for a lifetime, that's going to be very expensive. But it's going to be like the difference between a Bentley and an Acura. Okay, most people don't drive Bentleys, they drive Acuras. Okay, so that you buy an Acura style, and that will cover the average, the 3 years of needing care, or $300,000 or 400 or two, whatever your budget can afford. You're a lot better off with some than you are with none. And the reason why I say you're better off with some, because when you go into care, the caretaker, the caregiver is going to, in addition to the intake question, going to say, how are you going to pay for this? You pull out a policy, you're in. Okay, and let's say you go 2 years and all you had was $200,000 and you run out of money there. You're already in the system. Okay, and so you pay down, you spend down your assets. Now they flip you to Medi-Cal. You don't see any difference in care. You stay in that same bed, you get the same services. But the fact that you had a contract that said, oh, the first 200 or the first $300,000 is coming from the insurance policy, gets you into the system. And
that's interesting. I didn't know that. I thought when you ran out of money at a private care facility, if they didn't take Medi-Cal, they would just say, sorry, you got to move out.
I continue to question, and I do a lot of research with care agencies, with facility cares and with home care people, and say, oh, how do you treat it? When they run out of money, what do you do? It says, well, when we have them, we don't kick them out. We just flip them to a lower cost plan, but nothing changes on the care's perspective. Now that doesn't mean that, there may be some places who say, you're out when you can't pay the bill and you can't pay the 10 grand a month. You're out, but I haven't come across them yet.
Got it. All right. Well, we were planning on trying to keep this to 15 minutes. I think we went about 5 minutes over that or so.
I got 3 more hours here, man.
Like I said, if if we had a glass of beer or a little bit of Irish whiskey, we could probably talk well into the evening. But
A
I
couple
think for
of
the
days.
purposes of conveying some information now, why don't you just tell everybody how they can reach you, your website, your phone number, and then if people have follow-up questions or they want to reach out directly to you, that would be probably the best way.
Okay, well, I'm very lucky. My name is memorable. It's Jim Better. B is in Boston, Better. That's my LinkedIn connection. My telephone number is 562-424-1155. And you just go to LinkedIn or on my website. It's E is in Everett, P is in Paul, I is in India, N is in Nebraska, H is in Henry.com. EPINH. That's the link to my website.
Very good.
And
Well,
the last thing, Will, is I spend 90% of my time just educating people about the need to pay attention to what that risk is going to be. The question is, what is your plan? What are you going to do about this? The risk is there. The high probability that you're going to need to have some kind of care. Maybe it's 6 months, but maybe it's 5 years. That's what insurance is for. It's to
right.
cover that risk.
And and it's part of my my goal and my mission too as a realtor to educate and advise people. And that question of what is your plan is a question that I will ask some of my clients, especially as it doesn't really matter what age they are, but especially as they get older, and I'm never moving. Okay, so you're leaving like a lot of people. You're gonna leave toes up, as they say, and that's fine. That's your plan. But do you have, a plan? The house is still going to be there. What's going to happen? Or do you have your house in a trust? Because if just having it in a will is not going to avoid probate, you need to have a plan. When you have an asset, or when you have, people that are in your life that you want to care for, or like your mom wanted to pass something on to you, you need to have a plan. And those plans can't start, when you're 78 years old. It just doesn't work. I mean, I get it can if you're putting your house into a trust. It's never too late for that. And it's never too late to get insurance either, I guess. But better, like all things, to start early, do your research, find somebody you're comfortable working with, and then get the information you need to make a decision and move forward that way.
Indeed.
But it was great chatting with you today. If people want to reach me, you can reach me at flaniganhomes.com. My name, you can see it there. It's FLANNIGAN, flaniganhomes.com, or you can call me anytime at 310-920-1108. You can also text me there. It was great chatting with you today, and I will see you in a few weeks at our weekly or our monthly meeting at the estate planning group.
Good talking with you too, Will.
Nice
Thank
talking
you.
to you.